Welcome to Grow Your Wealth, a series brought to you by BQ Prime and powered by investment platform Grow, a platform that's fast, easy, and convenient when it comes to investing. Financial markets have become more and more popular among the retail investors. They want to look beyond the usual and traditional investment forms like fixed deposits, real estate, and gold. And equity investing is one of the most interesting and detailed asset class that is now captivating the minds of Indian investors. However, as more and more investors get on board this investment method, they do lack one common factor, and that is risk management. And that's exactly the topic that we'll be discussing today. It's Dr. C K Narayan who will be helping us out to understand and decipher this extremely important topic. Dr. Narayan is a veteran of India's financial markets. He's respected as one of the finest exponents of technical analysis in India, and he brings along with him nearly 4 decades of experience in insights on the Indian markets. He's been a part of large broking houses. He's catered to individuals at the retail level and headed large institutional desks servicing FIIs. He's also the founder of NeoTrade, which is an AI-based trading and analysis software. Dr. Narayan, thanks so much for joining in.
Thank you for having me here.
Dr. Narayan, I'm sure you'll appreciate when I say that, yes, there are lots of Indians who want to get into the markets. They're very enamored and appealed by the potential of returns that the markets can bring to them. We have heard of wonderful stories of rags to riches, which has been aided and assisted by the stock market. So why not? I guess it comes as a very little surprise that Indians are attracted to the stock market, but they lack risk management tools. How important is it for investors to have a strategy for risk management in place?
Well, according to me, it is the number one requirement. But sadly, most people who come to the market, especially the new guys, they aren't even aware of the existence of something like that. Now, you have something called beginner's luck, and everybody has a share of it. And they all come and try their hand, make a little money, and then they think this is easy. And then they get lucky, and sometimes they hit a streak, or some of them can even run a method. But most of them, they have no idea about this element called risk. According to me, it is the number one element that one should take a look at, because if you really look at this, the whole matter of investing or trading in the market, the only thing you can control, the only single thing that you can control, let me re-emphasize on that, is the amount of risk that you can take. The risk is purely in your hands. But what is everybody focused on? They're all focused on reward. Where does the reward come from? The reward comes from the market. It is the market's job to give you rewards, but it is your job to control your risk. But risk is unknown, because when you start off, there is always a risk, but you need to look for it, you need to provide for it, you need to be ready for it, and you'll be ready for it only when you are provided for it within your overall plan. So I think it's a number one element, and the sooner newbies start looking at this aspect of risk management, the better off they'll be, the more longevity they'll have in the market. People who get blown out of the water in the market are all those people who never looked at risk and always concentrated on reward. Reward is random and awarded by the market once in a while, but risk should be there with you every single day, and you should be mindful of it.
Absolutely. And, I will go as far as to say that it is impossible, Dr. Narayan, correct me if I'm wrong, it is impossible to get all of your trades, absolutely and 100% correct.
Absolutely.
So, Dr. Narayan, what are the risk management tools that you have deployed to ensure that any possible incorrect trades don't wipe out your capital and, possibly more?
See, just to repeat what you said, that it's not possible for us to be right in the market all the time. Now, if you ask even a layman, he saying, how do you think you'll be, you'll make money in the market? He'll say by being right in the market. And then if you follow that up with the second question, I ask him, do you think you'll be right every single time? Even the most of the laymen will say, no, I don't think I'll be right every single time. But even though people recognize this fact and they know it for a truth that they cannot be correct every single time in the market, when they put on a trade, they believe that every single trade of theirs is going to work. And that is never the case. So the simplest way to address this is something which most of us know, and it's called a stop loss, right? A stop loss is something which means exactly what those two words say, that stops your loss or curtails your loss or controls your loss to a certain level where you do not get blown out of the water. That should be the role of a stop loss. So you can have various types of stop loss. So, but one of the stop loss that you must have is what I would refer to as a disaster stop loss. Now, what's a disaster stop loss? It is something which will take you out of the game. Let's say you have a capital of 1 lakh. And if you put a stop loss at 1 lakh of rupees, then you don't have any more money left with to play. So therefore, it has to be a small percentage of your capital, say 2% or 3%, which will allow you to stay in the game for a longer period of. So stop loss is the most common one. The second one you can look at as a stop loss is something which is not used very often, but which I would recommend very strongly is something called as a time stop. Now, if you look back, this is particularly for people who have been trading for a while or investing for a while, you will realize or understand that in a lot of occasions, the stocks which work for you, the trades or investments which work for you, they start working for you almost from the word go. So if you turn that around on its head and say, if a trade or an investment does not work for me within a certain period of time, then maybe I should take a relook at it. And the first thing you should do is apply a time stop, saying that if it doesn't come through by X hours, X days, X weeks, X months, whatever is your time frame, you should take it off and take a relook. So that's a kind of a time stop, not usually deployed, but highly recommended. Third way that you can address risk is by taking profits regularly. Now, this is not a way to build wealth, but it is certainly something to stay alive in the game, to keep playing the game. If you're in the game, then eventually you'll make some wealth, but you must ensure that you remain in the game. So profit taking never killed anybody. Profit taking periodically just reduce the amount of total money that you can make. But once you learn the game nicely, then you'll be able to run your profits. And then the other way that you can also play this game is to have target levels. So profit taking goes with target levels. But instead of taking profits regularly at a target level, if you are more proficient at this game, you can do a reassessment when a target level is reached. So stop losses, disaster stop among them, time stops, periodic profit taking, and target level reassessment are some of the simpler things I would suggest. This is something that can be done by absolutely everybody. So, and they should do it. That is my advice.
Well, if you want to play in the game for the long term, then you must ensure that you are able to survive it. And these are some of the strategies that Dr. Narayan has shared. Now, trading very often tests the emotions and the psyche of investors. In fact, it does that rather constantly. Traders have to sometimes take snap decisions. Dr. Narayan, how do you recommend, or rather, how do you manage such a situation when you have to take an immediate decision?
Well, you see, snap decisions really come into play a lot more often, say, when you're an active player, right? So when you're an active player, then deeper knowledge of the market, deeper knowledge of analysis methods and techniques are necessary. And a practice of that is also a must, right? And it's only through practice that you will really be able to react at a much faster pace. It's like, let's take the military, where you're actually put through training so often and so rigorously that you reach a point where you can react without, thinking about it too much. One of the things which, comes to my mind readily is that legendary, kung fu movie, Bruce Lee. I think everybody knows Bruce Lee. Now, Bruce Lee is famously said that I am not afraid of a man who can do 10,000 kicks, but I'm certainly afraid of the man who has practiced a single kick 10,000 times. See, because a man who has practiced a single kick 10,000 times can deliver that kick extremely well, and that kick can almost be lethal. So you need to really practice, and practice is the main thing which will allow you to react instinctively. And that is the kind of thing that is required when you have to act without thinking. Intuition is what it looks like when you look at it from outside. But actually, intuition is a developed trait through practice.
Well, we like to give it the name intuition because it just makes it sound so very wonderful. And, you really want to get into the mind of that investor then who has actually used his or her intuition to get that profitable trade, I guess. But yes, the more realistic word for intuition is actually practice that he or she has been through over the last months or years. Another emotion that trading really tests is control, because in the last 2 years, we have seen, FOMO trades, meme stock trades. These are just names that have come up in the last 1 or 2 years. How should traders manage those kind of emotions? You don't want to miss out on the possibility of a profit, and that tends to make investors take very irrational decisions, pardon me. So how should investors and traders manage that?
You see, FOMO, or the fear of missing out, is experienced by people who generally do not have a fixed or a good method as an approach in the market, right? So they look at the market and they like something and they think they should do it. Then they hesitate, they procrastinate, they hesitate again. And then it reaches a point where they feel that they cannot miss out on this. And then they take the trade. And that is actually fear of missing out. But then you don't realize that much of the move is already over. So the only way that FOMO can be overcome by newbies or experienced trader is by having a good method. When I say a good method, what will really a good method do? A good method will identify high probability situations where you can take up a trade, a buy or a sell, right? Which will be signaled, where the method will also define the risk attached to taking the trade, as well as the potential reward that can come out of that trade. It will signal you in time that this is the moment to take it. So when you have a method, FOMO itself will get slowly blanked out of your psyche as a whole, or your approach. So the only way to overcome something like FOMO, which is the fear of missing out, is by having a method which you have practiced and internalized, so that whenever the signal shows up with well-defined risk parameters and the reward potential, it will tell you that this is the moment to take it, and therefore FOMO will no longer exist.
There's a saying that if somebody tells you they've managed to get 100% of their trades right, they're either God or they're lying. So to manage the possibility of you getting some trades wrong, and the possibility that these could wipe out your capital and possibly more, you must ensure that you have a proper risk management process in place. It's not very difficult. As Dr. Narayan said, these are absolute essentials, things like stop losses, etc. So go ahead and deploy them for your future trades. Dr. Narayan, once again, it's an absolute pleasure having you on board with us on this Grow Your Wealth series. Thank you so much for all of your insightful wisdom.
Thank you for having me.
And with that, we'll wrap it up on this episode. Thank you so much for tuning in.